In the ever-evolving world of finance, where fortunes can be made or lost in the blink of an eye, let's delve into the gripping tales of the top 5 biggest trading losses of all time. Starting us off at number 5 is Jerome Kerviel. Kerviel was a French trader who gained notoriety for his involvement in one of the largest financial scandals in history. Kerviel was born in 1977, and after getting his master's in finance, ended up working for Société Générale or SG, one of France's leading banks. The scandal, often referred to as the Société Générale trading loss, unfolded in 2008. Kerviel's actions came to light when SG reported losses of the US dollar equivalent of approximately $7.2 billion in January 2008. Investigations revealed that Kerviel had engaged in unauthorized and risky trades. He allegedly used various techniques to conceal the true extent of his positions, including creating fake transactions. The trades involved complex financial instruments, such as futures contracts and options, and Kerviel's activities went undetected for a considerable period of time. The massive losses incurred by SG had a significant impact on financial markets, and the incident raised questions about risk management practices within the banking industry. Kerviel was arrested in January 2008 and faced charges of breach of trust, forgery, and unauthorized computer use. During the trial, he argued that his superiors were aware of his activities and turned a blind eye as long as he was making profits. However, SG maintained that Kerviel acted alone and exceeded his mandate without their knowledge. In October 2010, Kerviel was found guilty on several counts, including breach of trust and unauthorized computer use. He was sentenced to 3 years in prison in order to pay restitution for the losses incurred by SG. Subsequent appeals led to adjustments in the verdict, with the prison sentence reduced and the restitution amount revised. The events surrounding Kerviel's actions remain a significant chapter in the history of financial scandals, highlighting the challenges of monitoring and controlling complex financial transactions within large institutions. Next up at number 4 is the Tsingshan Holding Group, or TSG, a major Chinese nickel maker. In early March 2022, a short squeeze rocked the London Metal Exchange, or LME's, nickel market, resulting in significant losses for market participants. This unexpected event occurred amid the Russia-Ukraine conflict, causing concerns about the global supply of nickel, a crucial component in stainless steel and batteries. TSG found itself on the wrong side of this short squeeze, holding a massive short position of over 150,000 tons of nickel, about 5 times the volume held by the LME. As geopolitical tensions escalated, long positions from major buyers like Volkswagen and JP Morgan drove nickel prices higher. TSG attempted to cover its short position, but this only created further upward pressure on prices. The LME allowed nickel prices to surge by around 250% in just a couple of days, reaching an all-time high of over $101,000 per metric ton. This unprecedented short squeeze triggered an $8 billion margin call on TSG, with JP Morgan arranging a rescue credit facility to address the liquidity squeeze. Finally, the LME suspended all trading of nickel and retroactively wiped out nearly $4 billion worth of transactions to demonstrate that prices had stopped reflecting the actual underlying physical market. Critics argue that the LME failed to anticipate the magnitude of TSG's short position, leading to a loss of confidence in the exchange. Despite the LME defending its actions, concerns persist about the future volatility of the nickel market. Coming in at number 3 is the 2012 JP Morgan Chase trading loss. This event gained widespread attention due to the magnitude of the financial losses and the implications for the banking industry. The trouble began with a complex financial strategy known as the London Whale trades, executed by a trader named Bruno Iskil within the bank's Chief Investment Office, or CIO. These trades involved derivatives tied to corporate debt and aimed at hedging risks. However, the strategy went awry as the positions taken by Iskill turned out to be much riskier than anticipated. In April 2012, it was revealed that the CIO had suffered substantial losses, initially estimated at $2 billion, but as investigations unfolded, the losses were revised to as much as $9 billion under worst-case scenarios. JP Morgan Chase faced significant criticism for its failure to effectively oversee and manage the risks associated with the trades. The fallout from the incident led to executive shakeups within the bank, including the resignation of top executives. It also prompted regulatory scrutiny and calls for stricter financial regulations. Rounding us off at number 2 is Howie Hubler. Hubler was a former trader at Morgan Stanley. Hubler's involvement in risky mortgage-related trades led to substantial losses for the bank and contributed to the broader economic downturn of the time. In the mid-2000s, Hubler oversaw a trading strategy that involved betting against subprime mortgage securities. The strategy initially yielded profits, but as the subprime mortgage market collapsed, Hubler's positions turned into massive losses. In 2007, Morgan Stanley announced a write-down loss of around $9.4 billion, primarily attributed to Hubler's trades. Hubler's risky bets involved more complex financial instruments, including collateralized debt obligations, which were tied to the performance of subprime mortgages. The collapse of the subprime market and the subsequent financial crisis exposed the vulnerabilities of such trading strategies. Naturally, Hubler left Morgan Stanley in 2007, and his actions became emblematic of the excessive risk-taking and lack of oversight that contributed to the financial crisis. The aftermath of Hubler's trades promoted increased scrutiny of risk management practices within banks and fueled calls for regulatory reforms to prevent similar crises in the future. The 2008 financial crisis had far-reaching consequences on the global economy, and Hubler's role in the events leading up to it serves as a cautionary tale about the dangers of speculative trading and the need for robust risk controls in the financial industry. And finally, coming in at number 1 is none other than Bill Hwang. Hwang was a South Korean-born American investor and the founder of Archegos Capital Management, or ACM. Hwang gained prominence and later infamy due to the collapse of ACM in March 2021, resulting in one of the largest margin calls in history. Hwang's investment strategy involved highly leveraged bets on a concentrated portfolio of stocks, often using complex strategies like total return swaps. ACM faced significant losses when several of its large positions, including Viacom CBS and Chinese tech stocks, experienced sharp declines. The downfall of ACM triggered a massive margin call from its prime brokers, leading to the forced liquidation of positions reportedly between $8 to $20 billion. This had a cascading effect on the stock prices of the companies involved and resulted in substantial losses for the banks facilitating ACM's trades. Regulators and financial institutions began scrutinizing the incident, raising questions about risk management practices and transparency in the hedge fund industry. ACM's story serves as a cautionary tale about the dangers of excessive leverage and concentrated positions in the markets, emphasizing the importance of risk management and regulatory scrutiny to prevent such incidents in the future. And there you have it, the top 5 biggest trading losses of all time, at least for now. Subscribe,